If you look at the stock market today, it feels like a closed system. Massive server farms execute trades in a fraction of a second, driven by algorithms that require a PhD to understand. But the professionals working on Wall Street operate under severe constraints. A mutual fund manager is judged on their performance every 3 months. If they miss a quarterly target, they have to explain to their bosses and their clients exactly what went wrong. That intense pressure breeds a herd mentality. It is much safer for a professional to lose a client's money investing in a widely accepted corporate giant like IBM than to risk their job betting on an unknown, unconventional company. Looking at this photograph from the 1980s, you see a man who rejected that conventional wisdom. This is Peter Lynch. He took over Fidelity's Magellan fund in 1977, and over the next 13 years, he grew its assets from $18 million to $14 billion. He achieved a 29.2. He did that by leaning into a thesis that frustrated the professionals. He believed that average people are actually better equipped to pick winning stocks than Wall Street experts. He realized that the ultimate investing advantage is not found by staring at a Bloomberg terminal. It is found by paying attention to your everyday environment. Lynch built his strategy around a simple idea: invest in what you know. The daily routines of regular consumers act as a massive, decentralized early warning system for financial growth. If you notice a coffee shop is constantly packed, or a fast food line is spilling out the door every day, you are gathering valuable data. Lynch himself bought shares of Dunkin' Donuts simply because he was impressed by their coffee as a customer, and he saw how busy their Boston locations were. This edge also extends to your day job. A doctor might notice a hospital ordering a new medical device, or a contractor might see every construction crew switching to a specific brand of power tools. That is what we call boots-on-the-ground knowledge. By the time an analyst discovers that same trend buried in a spreadsheet, the stock price has usually already moved. Loving a product does not automatically mean you should buy the stock. Liking a store is a reason to put a company on your research list. Before you invest a single dollar, you have to do the homework and kick the tires on the actual business. This diagram outlines the first step of that research: categorization. Lynch divided companies into 6 distinct buckets: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Once you know what kind of company you are dealing with, you run the 2-minute drill. You must be able to explain in 2 minutes or less exactly how the company makes its money and what its realistic plans are for future expansion. If you can't explain it simply, you don't understand it well enough to own it. Pinning down the category tells you which financial metrics actually matter. You wouldn't judge a rapidly expanding tech startup by the same dividend payout standards as a mature utility company. To evaluate those metrics, Lynch popularized a strategy known as GARP, or growth at a reasonable price. He wanted companies with strong expansion, but he refused to pay inflated, hype-driven prices for them. Looking at this formula, we can see his golden metric, the PEG ratio. You calculate this by taking a company's price-to-earnings ratio and dividing it by its annual earnings growth rate. As the equation transforms into this scale, you see the baseline. A PEG ratio that lands exactly at 1.0 means the stock is fairly valued. Its price is perfectly proportional to how fast it is growing. When that indicator drops well below 1.0, you have found the sweet spot, a stock that is growing faster than its current price suggests. But if the ratio swings past 2.0, the growth no longer justifies the cost, signaling the stock is heavily overpriced. Basic arithmetic is the only math required to prove whether a great consumer observation is actually a smart, viable investment. Even if you observe a brilliant consumer trend and perfectly calculate the PEG ratio, you still need one final trait. Lynch warned that having the brainpower to pick stocks is useless if you do not have the stomach to hold them. Watching this winter storm roll in, consider how Lynch viewed market volatility. He compared stock market declines to a January blizzard in Colorado. They are routine, unavoidable, and highly uncomfortable, but they are also temporary. Trying to dodge those blizzards by jumping in and out of the market is a losing game. Investors lose far more money trying to anticipate corrections than they ever lose in the corrections themselves. That patience is how you achieve a Tenbagger, Lynch's term for a stock that returns 10 times your original investment. Those massive, compounding returns rarely happen overnight. They almost always require holding the stock through turbulence for at least 3 to 4 years. That is the complete playbook. Observe the everyday world, do basic financial math, and stay invested when others panic.